Yes, sorry.
Okay. So good afternoon. Thank you for joining us. Apologies for the brief delay while we worked out some technical issues. So this is the Bruegel event on equity finance in the post-COVID recovery. It's a topic that has occupied us for years, and certainly now throughout the recession and crisis last year. A lot of discussions within Bruegel were about shifting from debt as a rescue in the crisis to equity as a source of resilience and growth for companies. As this is a online-only event in Bruegel that is open to the public, we invite you to submit questions on the separate website, which is sli.do. Enter the code equity finance, and I will see your questions and also how people react to this. And we certainly hope to discuss with you your views. And we are really delighted to have an expert panel here. Let me very briefly introduce the colleagues in order of their appearance. We have Laurent Zülberberg from Caisse de Dépôt, who is also chairman of the European Long-Term Investors Association, which is basically the Association of European Promotional Banks. We have James Chu of HSBC in London, who heads the regulatory strategy unit in HSBC. He's also a non-executive director with the Business Growth Fund, which will be a hugely relevant model and interesting case for our discussion of private equity. Thomas Wieser in Vienna is not just a non-resident fellow at Bruegel, but also previously president of the Euro Area Working Group, and chaired the high-level forum on the Capital Market Union. Many of the proposals made by that group will be quite relevant for the stimulation of equity finance. And last not least, Professor Katja Langenbucher is at Frankfurt University, has also been in that high-level forum group, and of course has published extensively on regulatory and legal issues around capital market integration in Europe. My name is Alex Lehmann. I'm a non-resident fellow at Bruegel and delighted to chair this discussion. Very briefly from my side, the introduction would be that we've seen many estimates of the shortfall in capital coming out of this crisis, and it's a sort of really dramatic erosion of firms' cash buffers. And the Commission preparing its own proposal for a solvency instrument estimated that shortfall under a mild scenario at just over 700 billion. Now that was back in May, and since then I think it's safe to say the scenario has deteriorated, and the recovery to normal business models has been further pushed back. There has also been a report by AFME, the Capital Markets Association, which came out just 2 weeks ago, that had an estimate of 1 trillion in terms of capital shortfall, so roughly in between the base and the adverse case estimated by the Commission. But I think it's safe to say that SMEs in particular will be highly vulnerable coming out of this crisis, and that now as many moratoria and loan guarantees expire, I think the vulnerability of corporate balance sheets will be very visible. So attention will shift to equity finance. There's no question about it. And I think what we hope to cover today is not just how overall equity can be stimulated, but also how the actors that we see currently can be directed to the right uses of capital. Let me give you two figures. So in the 3 years to 2019, capital markets mobilized roughly 450 billion, 2/3 of which was directed to companies that were already listed. Private equity raised about 300 billion, invested 250 billion, and roughly 80% or so went to so-called buyout investments, which are largely strongly growing, highly profitable firms. So the question is, are there investors who are geared up and have expertise for the type of companies that will need that type of equity injection? Yeah. So with this, let me turn to Laurent and maybe have a brief overview what the public development banks do in this area, and also how they can partner with private investors, given that really the so-called dry powder of equity investors is very significant currently. And I think one of the questions to you would be, how can this be leveraged through engaging in public-private partnerships, also possibly within the EIB group? Yeah. Laurent, over to you. Thank you.
Thank you, Alexander. Thank you all for the invitation. I would try to be brief and not to submerge you with figures. First of all, why do we speak about equity? The first reason is very simple, is because in equity, you can lose all your money, which is not always the case with loans. Basically, when you make loans, you expect to have a return, and if you want to take risks, you may expect to have between 90 and 95% of returns, which is not the case in equity. In equity, if you lose everything, or you can lose everything. So it is risky money. This is the first point. The second point is Europe is lacking of equity for now between 10 to 20 years, but roughly since 2008-2009 crisis, we can see that Europe is lagging behind other geographical areas in terms of equity, and especially in terms of private equity. Therefore, what's the role of the public bank and National Bank of Development? We use public money, which is not completely true. In fact, for some of us, we use private money for public use. When you deal with savings are private money. It is not public money, but it is used for public purposes. And therefore, our role is to leverage, as you say, with the private. And this is where we are good at. We are good when we can leverage on the private money, because we are first able to have, before investing, having an expertise on what is really important when you make equity, is to analyze where you put your money in. And this is where we can have an added value. The second point is we are able to take more risk because we are large or very large actors. Therefore, we can take some risk that small or medium actors cannot do. Then there is another issue, and this is the issue that you raised. Do we funnel the money to the right place? Of course, not always. We try to, and where is the money needed? The money is needed on the ground. And for that, we need to have a capital network. And this is where we complement EIB Group. And this is what we can see if we look at the Juncker plan, which was a plan launched by the European Commission in 2014. We saw that the effect was very good, but on the ground, it was mainly directed to large projects for one very obvious reason. The reason is because when you are in Luxembourg, you cannot have the vision of all the small, medium companies who need the investment, and those companies, they do not know you. And national bank, promotional banks, they are none on the ground. They have their own capital network. And this is why probably the European Commission and European Council decided to dedicate 25% of InvestEU for the direct guarantee for NPBI. And that means that on InvestEU, which is a kind of new Juncker plan, to make it simple, 75% of the guarantee will go through EIB Group, and 25% will go through each of will go through the NPBIs in their own country if they successfully passed some assessment. So this is what we are doing. Do we have the knowledge? Of course, we have our customers. They are small, medium companies. There are also some of them mid caps, but also we invest and we put equity in infrastructures. And this is very important because on SPV, on special purpose vehicle, you need to have at least 1/3 of the SPV, which is based on equity. And for this, you need to syndicate different type of providers for equity. And we are what we are, and I will finish on that. I think we are what I call enablers. We enable the private partners to invest because we offer them some guarantee. In some cases, we offer some de-risk of their own money, and therefore we enable the situation to develop. On the COVID crisis, I will be very brief on this. There is one, or there are many issues, but one of the issues is as we need to tackle the emergency. We need to help companies we are in real need today. There is a main risk that we do not invest for the long terms. And this is where we will need equity. And for this equity will be used for a very long time. Of course, there is a lot of pressure saying, well, let's use this money for the short term. Let's use this money for the direct and the emergency measures. But if this is the case, if we put all the money in that basket, we will lack for the long-term investments where we are already lagging in Europe. But I will leave the floor and I'll probably come back later.
Okay, thank you so much. Excellent introduction, and I'm sure we'll come back to the potential of the national development banks in converting and supporting the phase out of the loan moratoria and loan guarantees. Yeah. So James, could I turn to you because now the UK is out of the EU, but no doubt there is still a lot to learn from your experiences, and the Business Growth Fund, I think, demonstrated a very interesting model of equity financed, mobilized by commercial banks. So we first discussed this around the SME IPO fund, and I think the ability to scale up private equity investment in a less risk-seeking, less return-oriented investment that can be replicated without seeking ownership changes, maybe something that other public institutions in Europe can also replicate. So I think I'd be really interested to see how commercial banks can be instrumentalized in providing equity finance.
Yeah, and if I can just follow on from Laurent's point, I think we do need to get to equity because one of the interesting things in the data in the UK is the loan guarantee schemes are topping out. The capacity in the banking, the capacity for companies to absorb debt is quite clearly reaching its peak, and we need to get to equity. One of the concerns I have, and then we'll come on to the capacity building, is the time it takes to build the equity investment capacity from the gap that we have today. Because when we started out building BGF in 2011, as 10 years ago, and it's taken us some time to get to capacity. So we have a gap that we have to bridge. But yeah, BGF has been a really interesting story. So just for those who don't know, we set it up 10 years ago. It's owned by largely the 4 major banks in the UK. We have capacity to invest £2.5 billion. We've invested £2.5 billion, but we recycle the money. We hold a portfolio of about 1.9 billion in over 300 companies across the UK. So we've invested in 450 companies. We hold a portfolio over 300 in everything: alcohol, oil services, design agencies. So it's a very diversified portfolio in all the sectors. We have a very distributed office network, etc. And we're the largest growth capital investor in Europe by volume of transactions. So we did 62 transactions, I think, last year, which is for a private equity firm is phenomenal. But we have 200 people employed. And when we set out to build BGF, and it was in the aftermath of the last crisis, we deliberately set out to do things differently. And I think this is one of the things that we've been very successful at. So we set out to design a product that really wasn't available in the market at the time, which was, we were looking at equity investments of between 2 and 10 million pounds. They were minority investments, so they're not control investments, so they don't have the right to sell the business in the way that private equity does. They're not leveraged. They have no time frame in terms of exit. And that's also reflecting the corporate structure. It wasn't set up as a fund. It was set up as a company. So BGF has perpetual capital delivered from the bank shareholders. And it's also a collective vehicle by the bank shareholders. So it's designed to do what the banks can't do themselves, but where they can cooperate in building a market for their customers. I always say there are 3 reasons why the banks invest in BGF. 1 is it's good for the economy. 2 is they generate lending opportunities for themselves. And 3, they make money out of BGF. The other thing we set up was a new distribution network. So we use the banks for referrals, but we also get referrals from intermediaries. We set up an in-house management team. So this is not this is not effectively a fund of funds. This is actually deliberately building additional investment capacity. That's what we set out to do. We said the current investment capacity is not sufficient. And we effectively said, we're going to use the banks as the intermediaries, but we're also going to build the regional network. And that's been incredibly important. BGF, 70% of BGF deals are done outside of London and the Southeast in the UK. So it's a very, very regional model. And we set out to build a standardized product. If you go into a law firm in Birmingham as a company and want an investment, a standardized BGF investment, they'll say, right, we can almost show you the legal documents today as to what they're going to be like, the documents you sign. We'll just be filling in the bits and pieces. So we have a highly standardized approach. This is manufacturing. But the lessons we learned from that is, firstly, I think some of the lessons that come out of that is, you can build something by acting collectively, which is much, much better as banks than you can build by acting on your own. But that is hard. It is very hard to get banks to operate together. They are naturally competitive animals. So they have to see this as being something that they want to do together. And I've had these discussions. This is I've had these discussions 3 times, because in addition to BGF in the UK, we have the Canadian Business Growth Fund and we have the Australian Business Growth Fund. And I've sat in the meeting rooms in Canberra and in Ottawa with all the banks, with the governors of the central bank and the finance ministers saying, this is what you need to do to build a financial institution, a financial intermediary, which will help your businesses raise more money, which will enable you to lend more money to them. And you need to do it collectively. It's a little bit of like going back to the days when the stock exchanges were founded. They were founded by banks originally as instruments of financial intermediation for their companies. I think you also have to get away from the view that you're going to help all companies. So a lot of people, when I've been talking to people in Europe, they say equity is not the thing for Europe. The answer is it's not the thing for a lot of companies in the UK. It doesn't need to be. So if you take 100 companies and only 10 of them take equity, if they grow at 20%, that means you've added 2% to the growth of the 100 companies. So you don't need to help everybody. You just need to help those who want to be helped to achieve their goal. There will be a lot who don't take advantage of it. That doesn't matter. You've actually got to help those who want to grow, because it's the people who want to grow that are important. And the third thing is, I think you need to add capacity. So I think one of the concerns that we had when we looked at BGF is a lot of people recommended for us a fund of funds approach. And the concern that we had was we didn't see how that was going to create a new product and add capacity. It was going to give more money to the people who already had it. And when Thomas and I, well, Thomas was leading the CMU and I was CMU High Level Forum and I was working on it, one of the concerns that I had is private equity in the EU is very poorly distributed. It's quite good in France, it's quite good in the Nordics, it's quite good in Luxembourg, Netherlands, but it's very, very poor in other countries. And so you need to find ways to build the institutional capacity which will be able to deliver that. And that means that you need to think about getting together these groups. Now, I think the High Level Forum and the work that we did and the work that the EU is doing on CMU, I hope will bring banks into the equity investment space if we can get the risk weighting right. The risk weighting is crucial to this in terms of the pricing at which you can do investments. But it also, and it has in the UK and Canada and in Australia, it also takes a lot of political will and hard graft to do this. The reason why private equity doesn't do small deals is it's hard work. You have to work really hard to get money out of it. So you have to go at this and be willing to do hard yards. And that means political appetite. It means central bankers and finance ministers and commission officials sitting down with banks and others and persuading them that this is the thing they should do, given that these people naturally find it a little difficult to cooperate. I think the hardest place was the Australia, where the banks probably were most difficult to get to cooperate, slightly easier in Canada and in the UK, sorry, I'm telling tales out of school, but in the UK, of course, we had a financial crisis, which was an easier backdrop to doing this. The one thing I would say, and this is a conversation I've had with a number of people, is as we look at the recovery, so we've got to build these equity institutions. And I think more than anything else, I would urge people, if you want a different outcome to building these equity institutions, you will need to take a different approach. The classic approach has been to pump money out in a fund of funds basis. And I think if you want to build new capacity, you're going to have to do it differently. I don't know if that's helpful. Alex, any questions?
Perfect. Thank you. So plenty of material for discussion later on. Let me just ask you to be a bit more specific on one aspect. Do you think, given the scale of the challenge and the number of the distressed companies, can there be a across the board prepackaged approach whereby development banks, others convert guaranteed loans into equity and cut through this capacity and structure building that you outlined, and thereby have something that's ready to go, as it were, in the next this coming year when it's most needed? Because what you described is building up a very complex institution, backing by banks, which would be very time consuming.
Yeah, I've spent a lot of time thinking about this, and I think the answer is unfortunately no. It's very, very difficult, and I think there's a reason for that, which is I think for companies which have been affected by the crisis, there's a very different feel to the position they're in to companies which are normally go and look for equity. So companies that normally go and look for equity do it for two reasons. One is they want to grow, or two is they've made a mistake and they need to restructure their balance sheet, so they need more refinancing. And either way in those, the management is involved in that. They're either made a mistake and it's their fault, or they're keen to grow and they want to do it. The problem is that management and business owners here were innocent, as it were. They were innocent bystanders in a car crash. And for them, it's very, very difficult to give up that equity when they can't understand what has happened to them in some respects. And so I think the danger is that we face a real valuation gap between what realistic investors would want in return for their equity and what existing business owners are going to feel is right, is what they should give up. And as I said, there are an enormous number of companies who are really concerned about dilution and for whom equity is not the right solution. So I think the solution probably lies in the middle, which is finding ways to extend out the terms of the debt for those who want the terms of the debt extended out. But also for those who want to speed up repayments to take advantage of the inevitable opportunities that come after the crisis, to find ways to speed up equity. So immediately I would think about how do you put more financial capacity into the institutions that exist already, and that's something that's going on. But the second phase would be to build new institutions to give the EU more capacity over the coming years. And this rebuilding is going to be a long-term process. So you have to do both. You have to stretch the debt capacity into existing equity and build new equity at the same time, all three.
Okay, thank you. Okay, as you speak, our Twitter feed, as it were, is catching fire, so there'll be plenty to discuss in a moment, but let me turn to Thomas. So looking at the CMU working group, is there thinking that this is an agenda for the nation state, the member state, or is it that at the EU level, regulation is flawed in a way that can be fixed, and where new products such as hybrid debt or preferred debt, preferred stock would be defined and facilitated in the existing regulations that would allow an easy way out and stimulate equity finance that previously wasn't there. And so what is the thinking in terms of integrating where there is scope for harmonization? I mean, we know that tax and insolvency issues will be perennial issues that fragment markets, but what is there in the short term?
Thanks, Alex. I think what we've heard so far from Laurent and James are the short-term aspects stemming from the huge debts pile up that we've witnessed in the course of the last 12 months. And our work on CMU predates the pandemic, but we finalized the report last summer. So with the first experience of what kind of downturn there would be, that we had little idea of how far into 2021 that would be stretching. And one of the questions we were asked, and actually we asked ourselves, was, is this still relevant given the huge challenges that come with COVID-19 and the economic destruction that it's causing? And I think in reality, what we see, and I think that Laurent and James have just confirmed that, is it enormously strengthens the case for a stronger role of capital markets. If you think of what the fiscal challenges for government are, with all the support programs that they have been running, with the contingent liabilities that they've been running up, thinking ahead, would they ever conceivably be in a fiscal position to support the economy in the way that capital markets can? Next item, of course, greening of our economies. Do you think that fiscal firing power of governments by itself is not only necessary, but sufficient in order to finance all of these investments that we will need to undertake in order to fulfill our climate goals? And the answer is a clear no. So the need for deeper, stronger, more vibrant capital markets has, if anything, risen enormously over the past 12 months from an already high level. So there are short-term, very strong arguments, maybe difficult solutions given the short lead time, and possibly even stronger long-term arguments. And if we then look at the European Union of unfortunately only 27 member states, the only well-functioning national capital market is somewhere over the channel. And we are now 27 member states with 27 national capital markets. And if one is only slightly nasty, or a bit nasty, one can say of the 27, there are two kinds of member states. The one group is those who've got small capital markets, and the others who think they don't have small capital markets, but do. And I heard what James was saying, yes, Netherlands, Nordics, et cetera, but by comparison, smallish. And quite obviously here, scale matters, and scale is a function of a variety of factors, which in our report, which came out, 8 months ago or so, we tried to address. There are supply side factors, there are demand factors, there are barriers to cross-border investments, and there are issues with market structures. And you, Alex, you were just mentioning, for example, insolvency law, which is a de facto hindrance of investing in certain national capital markets, because it simply takes, in the case of problems, it takes an investor 4 times longer to access his or her collateral in Italy than it does in the Netherlands. So it is not a formal cross-border barrier, but it is a barrier to cross-border investment, if one may make that distinction. And there are necessary, large number of necessary conditions which may explain why in our report we've got 17 different recommendations. We managed to keep to 17 because we've got so many subdivisions of recommendations. In reality, if we'd let everybody sort of contemplate what he or she would love to improve, we probably ended up with 100. So we managed to keep to a manageable 1.5 dozen. And some of them are an issue of legal convergence or harmonization. Some of them have to do with getting rid of unintended consequences of already existing legislation. But some are discriminatory or stupid applications of national legislation, and others are because it's there. It's a bit like Mount Everest. And amongst these factors, I would just like to pick up one, namely national pension systems. There are few people who believe that pay-as-you-go national pension systems are fine and sustainable in the way they are today over the next decades. And most people who've been dealing with these issues are quite clear. You need, apart from the first pillar, you need well-functioning second and third pillar pension systems, which is one of the major reasons, in my view, why the Netherlands has got such a well-functioning and vibrant, for a comparatively small country, capital market, which is why my country, Austria, has such a minute capital market, because virtually everything is concentrated in the first pillar of the pay-as-you-go system. So doing pension reforms in and of itself already provides a major boost to national capital markets. And without that, it is my view that most of the other work will be necessary, but very definitely not sufficient. So demand factors play an immense role. And just, I don't want to walk you through through every, me and Katja don't want to walk you through each and every of the recommendations that we were making. Just as an example of bureaucratic stupidity or malevolence. In theory, we've got very good systems of refunding withholding tax on investments. Shouldn't be a problem. The laws are there, the infrastructures are there. Most people in tax administration speak a certain bit of foreign languages. We've got the European Commission willing to coordinate, but tax administrations live in their national shells. And there are many instances where, as an investor, you can wait for several months to get the foreign withholding tax refunded long after you've paid your domestic withholding tax. And between, for example, Belgium and France, there are instances where you simply don't get the foreign withholding tax back. So double whammy. Why the heck should you then be investing in that market? I'll just give you one example, which I like to make in order to portray what happens to a startup, small startup company. I usually pick Slovakia because it's next door to me. Got an sort of high-tech startup looking for funds in the Slovak capital market. Very small capital market, no interest, no takers, no risk takers. Now, with one of our first recommendations, a single access point for data, where in one data bank, for example, with ESMA, comparable company data is stored and is accessible to potential investors so that they can run due diligence. An investor, say from Finland, would be able to access the data of that company, provide funds. Without that single access point, it is presumably impossible to do that. We leave out a couple of steps of development, trying to go public. Going public in virtually all European Union member states is an incredibly expensive and bureaucratic process, incredibly expensive. And amongst the firms that James was mentioning for whom equity is not interesting, some for other reasons, but for some it is simply bloody expensive to get there. So we have one or the other recommendation in order at least to make that more accessible, cheaper, less bureaucratic, at least for small and medium enterprises who want to go public.
Okay, Thomas.
I'm being too long?
Let us continue in the discussion, and maybe if you could wrap up, and then we let Katja talk a bit about the legal complexities in a moment.
Okay, my excuses. So we've got these supply side issues, we've got demand side issues, we've got legislation which impedes insurance undertakings and banks from holding equity to what we consider to be a desirable extent in their portfolios. We've got legislation on securitization, which was so mismanaged that it essentially stopped intelligent securitization from being rejuvenated over the last years. And those are, let's say, the kind of recommendations to give you a flavor that I agreed to talk about, and Katja has more interesting and forward-looking one.
No, thank you so much. I learned a great deal from the high level, from the report your group produced. Let's turn to Katja Langenbucher. Just give us a few ideas what you think is realistic in the short term in terms of ironing out differences between member state regulations that could open up equity finance. Is it within capital market regulation? Is it within national laws such as insolvency or tax administration? What is an easy one?
Yeah, so I mean, I agree with Thomas that we were sitting there, you know, and all the old tales came again with we don't have the right capital market culture, and continental Europe isn't able to. All the startups we have go to the US, and then there's the really national character of 27 corporate law regimes. However, remember, it's true for corporate law. It's not so true for securities and capital markets law. Whereas it's right, of course, that both the UK and the Netherlands have a tradition of securities law. Most other countries are hesitant and lag back in a capital markets law culture. So I think the Capital Markets Union, with its focus on regulating securities and stealing some of what's been traditionally seen as corporate law issues and kind of drawing it over into the securities law arena, was a pretty good strategy. But I wanted to focus on a couple of parts of the CMU action plan on the buy side, because we've talked a lot about corporations so far, and there's this really cute quote from the action plan which the Commission has issued, which I was thinking about a lot when I guess most of you and me have watched what's been going on with the GameStop and Redding saga these days. And so the Commission was hoping to say, well, Europeans, especially young people, increasingly want to have a say in how companies are being run, notably as regards sustainability issues, and shareholder engagement must therefore be further facilitated by making voting easier for all investors. So that's one thing we've tried to achieve. Thomas has already talked about cross-border issues, about shareholder identification, and about chains of intermediaries. And the quote goes on, and corporate actions more efficient, and then in particular in a cross-border context. So that's one of the things which I've hinted at, which seems to be corporate laws, so seems to run into a lot of national hesitancy, but is open to being taken out of its corporate law context and kind of as an element implanted into the much more European regime of securities law. And I've always tried to advocate that with a look to the US, because evidently there we have state corporate law also, but we still have a lot of federal security law. Really, most of what's relevant in securities law in the US is federal law. And so that was a good model to try and pull something over into the capital markets union securities law part. And still kind of focusing on the retail investor side, there's quite a number of studies which came out lately, and they show that surprisingly, and different than what most people think and what we keep on focusing on, a large share of the rise in equity demand goes back to retail investors, interestingly enough. And so I think it's well worth focusing on what could enhance retail investor engagement and bringing this together with the GameStop saga. It's not only sort of fun for the retail investors, seems to be, it's also potentially cheaper. Thomas has already talked about the tremendous cost of going public in the traditional way. And so in the Capital Market Union plan, we focused some of our recommendations around what's called tokens and crypto assets, trying to make it possible to make something tradable in an easy, quick, and efficient way, which added on, as I say, also has sort of the fun of it, as we saw in the GameStop story. People seem to sit at home, you know, with much time, some money to spend, and suddenly that's what they do. And that might also be a solution to our Slovakian startup, you know, which sits in Slovakia and has a hard time accessing capital markets from there. As soon as we are able to push that to the internet in some form, given that we have neo brokers and the fees are going down, for actually you and me taking our smartphone, you know, and just buying something in the way we buy a book, which will be delivered on the next day. So yeah, I think that is something which we should focus on, and we did focus on in a couple of recommendations concerning tokens and crypto assets. And the Commission has not only taken that on board, but also has its separate plan on digitalization. So these two together, I think, are what I would focus on quite significantly. It brings me, though, also, I said the fun of it, but there's obviously also the risk of it. Again, going back to Laurent, what he said, you can lose all your money. Well, that is true. And some of the GameStop people said, well, we're happy to lose it if we can only kick the mean hedge funds. But so that brings us to financial literacy, which is also a point we address in our Capital Market Union plan. Yes, it does sound fun, but then, you know, you always need to look closer, and still taking the GameStop story, it brings us to kickbacks, it brings us to conflicts of interests, and these, I guess, are the most important ones to be addressed. Keeping in line a bit of a more open culture, which securities law brings into the kind of old conservative stale world of continental corporate law. So that also brings me to my very last point, which, as you know, we couldn't really settle on a recommendation, but some of us would have liked to, which is supervision. And again, as you know, teaching, you need stories. And so Wirecard is the other story everybody has in mind right now. And Wirecard doubly and 3 times makes us think about the sense of maybe having a more central supervisory board body. And I think this would also change the culture towards something less national, coming from this national corporate law. Mm-hmm. It would bring us towards a more, and I'm not saying we need this one super monster authority, which is going to take care of everything. I would, Thomas always called it a hub and spoke system. I think it's a good thing, you'll have kind of the spider in the middle of the net and reaching out in all the different countries.
Okay.
Yeah, those are my three. I've always been
Right.
so honest.
Okay, wonderful. Thank you. Thank you. A really rich discussion. I wish your off-the-record discussions were public, and many ideas, I'm sure, were not aired. Let's take a good 10 minutes for Q&A, and I'll be really short. And we have plenty of questions here on the Slido. But let me start with one from Andreas Streichel, and the question is, will there need to be incentives, in particular of tax nature, for banks investing or investors in BGF, the Business Growth Fund in the UK? And let me add one other question that comes up, given the liquidity in banks, and that banks have been termed to be part of the solution of the problem. How could banks be incentivized to participate in an equity vehicle? I guess that's a question to James, first of all.
Yeah, so there's no tax incentives in BGF in any of the countries in which we set it up. It is a risk-weighted asset, and that really matters. And I'll try and explain why without drawing a complicated diagram. If you take a 10% return on SMEs in the portfolio, to a lot of investors that may seem to be a slightly inadequate return on the risk that they're taking. But if that return is coming into a bank as a return on risk-weighted assets, and the risk weighting and the Basel regime is looking at a risk weighting of between 250 and 400%, and at 400%, by the way, this doesn't work, but at 250 it does. And that was one of the important points we made to the Commission. At 250% on a risk-weighted asset, the return in the bank's hands is much higher because it has the inherent leverage within the bank balance sheet, and that means that for the banks, a 10% return in the portfolio is a reasonable return to them in terms of return on equity. By the way, that's really important for the companies as well, because if you think about what private equity are doing, they are putting the leverage in the company, which puts the company at greater risk. In the BGF, we're putting the leverage in the bank, where it's actually we're most capable of dealing with it and looking at things on a long-term perspective. So what I would say is, we didn't need a tax break. We had an economic incentive to make BGF work, but B, the mathematics of leverage meant that the returns to the banks should, over the long term, and it's a long-term play, actually give us a pretty decent return. And so we should be happy with that. And I think what we're doing now is building a portfolio which we can then demonstrate those returns to other investors who, once you've built it, may well be willing to take it on. And this is a sort of classic bank builds the infrastructure and then sells it on model. And that's what we've effectively, what we're doing in the UK. We've built the infrastructure, we've taken the long-term return, taken the long-term bet. We've got some decent returns. Now, other people may come in and take it on from us.
Okay, thank you. Right, so another question, given that the Commission's solvency support initiative was shelved, what other options do you see, given the urgency of firms' emerging solvency issues? What are the alternatives open to member states, or, if I may add, to the EU itself? Maybe that's a question to Laurent or Thomas.
Okay, I don't know if I will immediately answer to your question, but I will react on what James, Katja, and Thomas said. And I will quote two authors, which normally you don't quote them together. The first one is Ronald Reagan, and the second is Jean-Paul Sartre. About the fiscal rebate, I would quote Ronald Reagan. I don't think that fiscal rebate is not the solution. Fiscal rebate is the problem nowadays. And what now we need is we need to have public tools, and for this we need to fuel them. And so I don't really think that by doing taxes rebate or whatever, we will help for the public tools, because the public tools and public financial or public banks, we need the money for enabling private money for de-risking their action. If we don't do that, the economy will not go. And this is why we are so important at the moment for the relaunch of the economy. On Jean-Paul Sartre, I was thinking about it on what Thomas said about the bureaucracy, and I think that the translation of the piece is no exit for Reclos. And in this piece, it is said that the hell is the other people, and bureaucracy is always the other. We never think about ourselves as bureaucrats, but we are all producing bureaucracy. And I think that and I will come back to your question. One of the issues we have today is, if we want to take risk, if we want to invest in equity, it is much more expensive than in debt. And this is the reason why. It's because of the rule of Basel III and so on. Now there is no special treatment for long-term investments. There is no special treatment for equity. And this is what we need. We need to have a special treatment for this. And we need it very quickly, because if we don't do it, we will have a big issue. The gap, once again, the gap between equity and in Europe and other parts of the world will widen. And this is a very important issue.
Okay.
And for this, I think that we also need, and I fully agree with what Thomas said, we need the capital market union to develop the equity for that.
Okay, great. Thank you. One more question. What role can equity take in dealing with the green transition? And in particular, given the regulatory changes like the taxonomy, will that foster change and investment in Europe? Laurent or Katja, do you have thoughts on that?
Well, obviously a big role. I mean, we need all kinds of money we can get for the green transition, and the idea from the Commission side has been pretty clear so far, that they were going to support it. Plus, Europe has a small but there a chance to take, I wouldn't say a leading role, but at least a noticeable role with the taxonomy. I know that's been a lot of criticism about the taxonomy, but it's also been seen and understood and appreciated. And especially due to the last couple of 4 years in the United States, there was the option to take the lead, and I think Europe has at least tried. So there's no doubt that equity and sustainability belong together.
Yeah, okay. Good. So let me, as we are slightly over time, give you each a very brief final comment and opportunity, maybe starting with Thomas. What is it you would hope for in the very near term in mobilizing equity investors to support the recovery and preventing viable but illiquid firms from going under unnecessarily? Is there, what is your wish list, if you may add or pick one from your high-level group or your other work? What is it you would advise the EU Commission now?
Well, if I think of all the moratoria, public guarantees, etc., by the end of this year, banks will be holding collateral that they never really wanted like this. And governments will have had to honor guarantees which they probably would also not have wanted to have to honor in that way. So there will be huge changes in ownership in a large segment of assets in our economies, and that can be well handled or terribly handled. And what we would need right now is for banks, public promotion banks, governments, and regulators to sit down together, probably in each and every member state, and figure out how to use this change of potential contingent ownership as a springboard for a more dynamic, for making dynamic use of this, and not of saying, oh, what the heck have I got here? Let's dispose of it as rapidly and cheaply as possible.
Okay.
Which will lead to massive insolvencies, further insolvencies down the road. So I think sort of national, you've got to bring all actors together, and you've got to do it in February now.
Right. Okay. Thank you. James, very briefly, please.
Yeah, I absolutely agree with Thomas. I mean, we've got to bring them together. And I think it does have to be a national level, because that's the level at which the schemes have been put together, although they're blessed by the Commission in terms of state aid. The schemes are running out, and the equity will take time to come. But I think we do need to look to building those long-term institutions. And I'd reiterate, don't do the same things as we've done in the past. If we want a different outcome, we need to do things differently.
Okay, thank you. Laurent, very brief, please.
No, I think that if I have only one wish, is that we accept the complexity of financing the economy, and we accept that we must differentiate long-term from short terms, and we don't sacrifice the long-term from the short-term.
Okay, thank you. And Katja, the very final word to you, please.
We need intelligent institutional design, bringing together the best from all the worlds, the little bit corporate law left and the more forward-looking securities law. Plus, we need to bring together what Thomas already hinted on, public state competence and authority with private competence.
Okay, wonderful. Okay, well, thank you so much. I hope our brief discussion this afternoon has added a bit to insights in the debate, which I'm sure will continue. Thank you so much for joining, and we hope to continue this discussion on capital market aspects at Bruegel. Follow us, and all the best to your efforts wherever you are. Stay well, and hope to see you soon. Thank you so much.
Thank you.
Yeah.
Goodbye.
Alex.
Thank you. Bye.
Bye.